Hello and welcome to ChartMill. In today's video we will take a closer look at the Awesome Oscillator created by technical analyst Bill Williams. The Awesome Oscillator is a momentum indicator that provides insight into how strong or how weak a stock is performing. This is done by comparing the recent market momentum with the more general momentum over a longer period in the past. This confirms existing trends or can be used to anticipate changes in trends. The Awesome Oscillator calculates the difference of a 34 with a 5-day simple moving average. In contrast to many other indicators that use moving averages, the calculation here is not based on closing prices, but rather on the middle price of each period, so the high and low divided by 2. The obtained readings of the Awesome Oscillator are shown as green and red bars in a histogram which are above or below the zero line. A red bar is formed if the value of this bar is lower than the previous bar in the histogram. A green bar appears when the values of this bar exceeds the previous bar in the histogram. Values higher than 0 indicate an upward price movement. The short-term momentum is higher than the long-term momentum. And values below 0 indicate a downward trend. Short-term momentum is lower than long-term momentum. Crossings above and below the zero line should be interpreted as confirmation signals. In the chart we have indicated 2 points. The green circle shows an upward crossing of the zero line, indicating that the price is rising and buyers are gaining the upper hand. The red circle is a downward cross of the zero line, a warning that sellers are on top. However, do not make the mistake of simply buying or selling at the cross above or below the zero line. Contrary to what the chart suggests, the chances of false signals are quite high. Take a look at the chart where the price of the stock does not show a distinct trend at any time, so the up and down crosses follow each other in rapid succession. If you had gone long or short for this stock each time based on the crossing of the zero line, just about all signals would have resulted in losses. This method is used to identify interim price retracements in a bullish or bearish trend and enter a position in the direction of the existing trend. To source bullish entry conditions, the value of the oscillator is above the zero line, a peak of green consecutive bars is visible, and at least 2 consecutive red bars, of which the second bar being lower than the first, are followed by another green bar. To source bearish entry conditions, the value of the oscillator is below the zero line, and a bottom is visible of red consecutive bars, and at least 2 consecutive green bars, where the second bar is higher than the first, are followed by another red bar. Unlike the Saucer method, the Twin Peaks method looks for true reversal signals following a sequence of 2 price peaks or price bottoms. As the name implies, it comes down to identifying 2 peaks in momentum. The Twin Peaks entry is possible both as a bullish or bearish signal. Twin Peaks bullish entry conditions. 2 low points are visible in the indicator, whereby the second low point is clearly higher than the first low point. Between the 2 lows, the value of the oscillator should not have exceeded the zero line. And the first green bar after the second low is the warning signal. The following day, a long position can be considered based on this upward momentum. Conditions for a bearish Twin Peaks signal are just the opposite. 2 highs are visible in the indicator where the second high is clearly lower than the first high. Between the 2 highs, the value of the oscillator must not have fallen below the zero line. And the first red bar after the second high is the warning signal. A short position can be considered in the next period based on this downward momentum. Finally, this Awesome Oscillator generates divergence signals, as is the case with the RSI or MACD indicator, for example. A bullish divergence signal occurs when price shows a lower bottom and the Awesome Oscillator shows a higher bottom. This can be a sign that the prevailing downward trend is losing strength and momentum, causing opportunities to arise on the buy side. A bearish divergence signal occurs when the price makes a higher top in contrast to the oscillator, which shows a lower top. This can be a sign that the prevailing upward trend is losing strength and momentum, leading to opportunities on the sell side. Just like in all of our other articles and videos about the use of technical indicators, we need to emphasize that this awesome oscillator can't be used on its own to generate buy or sell signals. The accuracy of this indicator, or any other technical indicator for that matter, is simply not reliable enough on its own. When analyzing possible buy opportunities, you should, in addition to the mere long or short signal from the oscillator, look for as many converging elements as possible to support your setup. And what we mean exactly by this is shown in this example, where several elements are present together, which makes the actual setup a lot more interesting to monitor. So the stock is above the SMA 200, which is a bullish long-term trend. There is a breakout above a descending trend line. Bullish divergence between price versus the awesome oscillator. And finally, the awesome oscillator rises above the zero line. So the awesome oscillator is a very versatile momentum indicator that can be used in multiple ways. However, always keep in mind that 100% accuracy is impossible and losing positions are just part of any trading strategy. So if you enjoyed this video, be sure to give us a thumbs up and subscribe to the channel so you can stay updated on future videos. Trade safe and see you next time.